Welcome to another episode of Facebook Live. My name's Anthony Peluso, CEO, founder of Wealth for Life. Actually, I'm not CEO anymore. I gave that role to somebody else. So I'm just the founder of Wealth for Life and Australian property expert. So today I'm going to talk to you about the only 3 ways to make money from property or real estate, okay? Because there's actually only 3 ways to make money. And a lot of people get confused with regards to these 3 strategies, and not all strategies are suited to every person, okay? So it does depend on your situation, it does depend on your goal and what it is you're trying to achieve. So I'll go through the 3 strategies with you. Number 1, the most common way is through what we call our capital appreciation strategy, okay? That's simply put where you buy an asset, it appreciates in value, and the increase in value, the equity in the middle, is your net worth. Okay, that's how you build wealth, and you obviously got to know how to turn that equity into income. The most common way is that people just sell the asset and then crystallize the cash. Probably not the smartest way to do it, but the capital appreciation strategy is the strategy that most Australians adopt. What are the pros for something like that? By far the safest strategy, okay? And what most people measure their net worth against, okay? So if you ever look at the richest people in the world, their income, or their net worth, I should say, is not measured by cash flow, okay? It's measured by equity. So equity they usually have in businesses, shares they have in businesses, value of their portfolios, value of their shares within their own business and other businesses, but very few people are measured on cash flow and income, okay? Because the smart people understand that that's not a very good way to build wealth, okay? So you want to create equity, be it in a brand, in a business, in a tangible asset, okay? So capital appreciation is nothing more than, say, buying an asset for, say, $500,000, $500,000, having it appreciate to, say, $1.5 million, you selling it off minus the cost, you've got $1 million, okay? So that's one way of turning that into cash, right? Not necessarily an income, okay? So capital appreciation is the most common way that Australians build wealth when it comes to real estate. And again, the pros of that, that it's generally safe, it's used by a lot of people, it's not that difficult to do. The cons are that when you're buying real estate that's got very good capital growth or very good capital appreciation, the downside to that is that those properties usually cost you more than the income they're producing, okay? So the rent doesn't cover the mortgage repayments, the interest repayments, and the expenses, okay? So then you have this negative gearing thing going on, okay? Which can turn some people off. A lot of commentators out there don't have a different view with regards to a strategy such as that, and I understand all that, but again, you need to understand what is it that you're trying to achieve, okay? So capital appreciation is a very safe strategy used by basically anyone that creates wealth in Australia. Serious Wealth uses that as part of their strategy. I wouldn't say they use that as the only strategy, but it's certainly a fundamental part of their investment strategy, okay? And that's just your asset appreciating in value, okay? But understand that your rents won't cover the expenses or the interest, so you've got negative gearing of some sort going on. So you need to be in the right position financially to be able to afford something like that. So if you want a very good income, a very good working income, this could be a very good strategy for you, okay? If cash flow is already an issue for you, I wouldn't adopt a strategy such as this, okay? Because you're going to rely on your after-tax position to be able to help you cash flow the shortfall, okay? Second strategy is what I call the positive cash flow strategy, okay? Now, traditionally speaking, this is where your rent on an investment property is greater than the interest and the expenses. So after all your expenses are covered before tax, you have a positive cash flow, okay? So this strategy was very, very popular with a particular author that wrote a book, say 10, 15 years ago, where all he did was buy property that was positive cash flow. Now, yes, that gives you an extra income every week, okay? The positive is that you get the income, and yes, you've got to pay tax on it, right? But that's the negative. So you're getting a portfolio that's cash flowing you good income. The negative side to that is that usually these properties are found in what I would call less desirable locations, okay? So they don't appreciate a lot in value. Now, the negative to that is that if you're requiring on the increase in value of such properties, you may be waiting a very, very long time, okay? So it could stall your investment strategy very, very quickly, because whilst you're getting the income and it adds to your serviceability and gives you a strong position before tax, you're then having to rely on other means to actually create equity or get deposit for your next purchase, okay? So I wouldn't say it's the most popular investment strategy out there, but again, who really cares about popular, right? But it's certainly something that one adopts if income is their prime driver or key criteria for investing. But just be careful with an approach such as that, because if you're having to sacrifice capital growth, just remember, people get measured, their net worth is measured on equity, not income, okay? If you have to sacrifice capital growth, you may have a portfolio that, that'll get halted very, very, very quickly unless you have another means to actually come up with a deposit, okay? So that's the positive cash flow strategy. The third one I should say, is what I call the instant income strategy. Now this is where you get to, and by the way, the more, the first one, capital appreciation, very low risk, positive cash flow, a little bit higher risk, instant income, the greatest risk out of all three, okay? And this is where you've got your traditional property developer, okay? This is where the traditional property developer sits, where he's creating instant income. And this could be in the form of buying property, renovating it and selling it, okay? You're just flipping properties and you're just creating income and cash, okay? And it's done instantly, okay? Even with property development, where you're not having to wait for the appreciation to take place, you manufacture the capital growth by changing the value of the asset as fast as possible and not waiting for time or the market to do that. So, finding a piece of land, right, subdividing it, again, you get more value on the land now that you've got more blocks. A building where you're able to pick up the building, change its zoning, change its use, build on top. So anything that you can where you can manufacture value or growth gives you instant income. Buying an asset, renovating it, doing it up, selling it. Getting into developing where you're actually developing real estate and then selling your assets gives you that instant income, okay? So, very high risk, okay, because you really need to know what you're doing there. The rewards are greater, but like anything in life, the risk also becomes greater. And I'm certainly not saying you don't need to do that or you don't do that, but just understand everything in life has a plus and a minus, and I mean everything. And you'd be quite naive to just look at the pluses and just as naive to just look at the minuses, okay? So have a look at what works best for you. And that comes down to, again, what it is you're trying to achieve, what your goal is, and your current position, okay? In terms of income, work stability, age, family, location, time. Like if you don't have a lot of time on your hand, doing the instant income strategy may not work for you, okay? You're probably more suited to, a capital appreciation strategy. Now, which one do I recommend? Well, here's the ultimate strategy, okay? One that I haven't shared with you yet, and that's combining all three together, okay? Now, I've been able to do this very successfully in my portfolio over the last 20 years, okay? Where you have a capital appreciation strategy, right? Positive cash flow property that then handles the shortfall on the capital appreciation properties or the capital growth strategy. So then your portfolio looks after itself. And then you go create instant income where you're developing, renovating, building, and so forth, okay? So that's the ultimate strategy. And smart developers, what they do is when they're doing a development, they won't sell all of the development. They'll keep a portion of their development, and again, they'll do their financials on that. right? Just more so with trying how they minimise capital gains tax, income tax, GST, and so forth. Or not so much GST, but how they minimise their losses on their statements. So they'll keep a portion of their properties, right? That'll be debt free, and they'll turn the equity into those properties into income, okay? So they'll borrow against the value of those assets and then treat that as income. Why? Because it's cheaper to actually borrow money at a 4% interest rate than it is to pay your marginal tax rate on what you declare as taxable income, okay? Another conversation, but if you can get your head around that, that is so powerful. When I understood that, you will see how getting an income from work is probably the worst income you can get. I'll say that again, okay? Deriving an income from work where you are paid for your time as an employee, let's say, and then having to pay tax on that income, worst type of income you can get, the most expensive income as well. One, because you're having to sacrifice your time. Two, the tax treatment on it is bad, okay? A better way to create income is to have assets where you draw on the equity and turn the equity into income, because then you're only paying interest on the money you use. And let's face it, if you're paying 30% in the marginal tax rate and you're borrowing money from, say, CBA at 4% or 5%, money's money, right? Does it really matter where it comes from? You need to get your head around a strategy such as that. You'll think of income and money very different, and especially the cost of your money. But what a lot of developers do is they'll keep, and this is the ultimate strategy, where they'll develop a building such as the one right outside my window right now. They'll keep a portion of the development, sell enough off to cover all their debt, right, and exposure, and then hold on to the rest, which will be debt free, and they borrow against it, and they get into their next project. This is a way where you can actually then have assets that appreciate in value. You've covered the income. You've got no debt to cover, and you've created instant income. So you combine all three strategies into one. And this is where I recommend all of you aspire to play this game at, because that's where you're going to have the most amount of fun. Yeah, there's a little bit of risk involved, but you know what? It forces you to knowledge up. It forces you to learn, to skill up, to get knowledge, to pay attention, to wake up, to study, to observe, to analyze, to look. Okay? But the rewards are phenomenal, okay? But understand there's risk involved, okay? And it's not for everyone. So, but an amazing strategy, one I've been using for quite some time now. And if you want to, just dip your toe in, look at doing some type of renovation, okay? Renovations were very popular back, when all these shows hit the air 15 years ago, right? Right now, they're a little bit more trickier. I mean, you've got to be a little bit more switched on, because the price you pay it's always been the key factor, but you're starting to get unrenovated property almost going for the same price as renovated property, and people don't understand the maximum and the top and the bottom within a market. Okay, so if you're going into a particular suburb, let's say South Melbourne, okay, in Melbourne, Australia. You need to understand the maximum sale price, the maximum price in South Melbourne, and the minimum for the particular asset that you're looking to renovate, okay? Let's say you're looking at houses, right? Fully renovated, 4-bedroom homes, 2 bathrooms, double garage homes on a sizable block of land in South Melbourne, right? You need to understand the maximum anybody's prepared to pay for that and have paid for that. And then you need to understand the bottom of the market as well, okay? And from there, you should be able to ascertain whether you can make any money using a strategy such as buying, renovating and selling in a suburb such as South Melbourne, okay? So once you understand the top and the bottom, there's obviously a lot of other factors you need to understand. You can determine whether that's a suburb you want to invest more time and energy into, okay? But renovating is probably the dipping your toe approach that you would take to something such as creating an instant income. But the most amazing thing you can do is create a strategy that involves all three, okay? Your long-term net worth, your stuff that's going to look after your kids, your family, your retirement fund is your capital appreciation strategy, okay? It's slow, it's boring, okay? You still got to do it properly, and it doesn't require as much skill as the rest, okay? But then you've got to handle the negative cash flow on that, so you adopt a positive income or positive cash flow strategy, okay? The assets, though, don't appreciate as much, okay? So you balance out your portfolio with appreciation and cash flow, right? Then that frees up your time to not have to worry about money. Then you create an instant income strategy, okay? And as some of our clients have done, they've quit their jobs and create an instant income strategy where they become builders, developers, renovators, and take on projects quite small and then build up from there. And that's why property development is quite popular, okay? Extremely lucrative. Just about everyone's favorite pastime that's got money, but you need to understand the risks involved, okay? So don't go jumping into something like that. Have a chat to us, okay? I've been fortunate enough to adopt and use all of these strategies that I've spoken to you about in the last 20 minutes or so. So come in and have a chat to us. And I'm always going to say the same thing. Number one, what is it that you are trying to achieve? What's the end game? Okay? What's your exit strategy? Where do you want to be when it's all said and done? Okay? Because for a lot of us, you know, it's a passive income goal. Okay? Example, I want to be earning, Anthony, $200,000 a year coming into my bank account for the rest of my life, whether I choose to work or not choose to work. Okay? And that's the most common one that our clients want to achieve. And once you've understood what the end looks like, believe me when I tell you, the rest is actually quite easy. Okay? Because then we know what we're going for, we know what our target is, what our goal is, we can see what it looks like. Okay, and then we just work backwards, and it's actually quite easy to achieve, okay? So, in summarizing, number one, your capital appreciation strategy. Number two, your positive cash flow strategy. And number three, your instant income strategy. When you buckle it down, they are the only three ways to make money from real estate, okay? I hope you've enjoyed this episode of Ask Anthony, and please ask Anthony, because Anthony would like a question every now and then. Ask Anthony, Facebook Live. We're going to continue to do these every week. Please tune in, and I'd love to hear what you guys want to hear about. There's so much going on at the moment in the real estate market and finance markets. Things are changing, okay? Things are changing, and I personally think they're changing for the good. But I'm keen to hear your feedback. If there's any questions or any topics you want me to have a chat about, more than happy to do so. I've been doing this for 20 years. We do it every day, and that includes Saturdays and Sundays, at least for me anyway. So this is my life. This is what I love doing. I love helping people. I love helping people, do well financially and in any area of life if I can. I love seeing people realize their full potential, get knowledged up, get skilled up, because there's nothing you can't do when you understand how to do something, right? Makes sense, right? People tell me the share market's too risky. Not really. You just don't have enough knowledge in the share market. I know hundreds of people that have made fortunes in the share market. So what's the definition of risk? Definition of risk is the unwillingness to take responsibility in a particular area of your life. Okay? You go cross the road, right, when you were younger. Scary, right? You look left, you look right, but you make it across the other side. That's life, buddy. You know, it's like you look left, you look right, and then you move forward. So nobody's ever saying you don't look left and don't look right, okay? So study up, knowledge up. Education's the most important thing, but make sure the education brings you closer to your purpose, to your goal. Therefore, it needs to be something that you can actually apply, okay? Because just reading something and doing nothing with it is just a waste of time, okay? Thanks, guys. Thanks for listening to me one more time, and we'll see you next Tuesday.